Why is the UAE suddenly in focus, and what could it mean for your portfolio? Here's how tension around a single choke point can ripple through oil, shipping, and credit in a matter of hours. The United Arab Emirates sits beside the Strait of Hormuz, where about a fifth of the world's petroleum flows. When investors worry about that lane, they worry about prompt supply, freight costs, and the price of risk. Iran is probing regional fault lines and has tools, directly and through proxies, that can pressure sea lanes and infrastructure. The base case is not a long war. It is episodic disruptions that are short, sharp, and market-moving. What changed is range and reach. Drones and missiles demonstrated in recent years extend deeper across Gulf air and maritime routes. That complicates defenses, nudges up insurance premia, and raises the odds of localized incidents that slow traffic. Energy centrality has also intensified. Roughly 21 million barrels per day transit the strait, close to 20% of global consumption. Even a brief slowdown can tighten near-term crude supply and lift the futures curve. Tanker day rates and war risk surcharges can jump in tandem. The UAE's economy is more exposed than before, not because of oil alone, but because it is now a major hub for finance, logistics, and tourism. If airspace or port operations are disrupted, service sectors feel it quickly. That matters for airlines, shippers, insurers, and regional lenders as much as for drillers. Security ties have shifted since the 2020 normalization accords. Deeper commercial and defense links with Western partners and Israel change deterrence dynamics and perceived targets. Markets read that as both a backstop and a source of headline risk. Keep the numbers in mind. The UAE produces about 3.2 million barrels per day and aims for roughly 5 million in capacity in coming years. That helps medium-term resilience, but near-term flows still depend on the choke point. And there is precedent for fast repricing. Brent spiked around 20% intraday after the 2019 Abqaiq attacks in Saudi Arabia. For investors, the playbook is about timing and transmission. Watch Brent time spreads, tanker rates, and war risk insurance quotes. Track GCC sovereign and bank CDS, airline equities, and port throughput data. Consider how energy producers, refiners, and tankers respond versus airlines, tourism, and importers. Think in hedges, not hunches. Selective energy exposure, volatility buffers, and clear exit rules for event risk. Bottom line, expect episodic shocks, fast moves, and quick reversals. Prepare for them before headlines hit and size positions to withstand noise. Read the full article at finlitica.com. Quick reminder, this is general information, not financial advice. Your money, your decisions, so always do your own research.